over in Metairie. And then we have our 101 core course in November in Metairie as well. So y'all just keep an eye out for the communication regarding that, or go to the CCIM Louisiana website. The golf tournament is back. We're going to La Triomphe Country Club in Lafayette. If you've been before, it's a great event. So take a look at either signing up individually or for a 4-person team. So that should be a great event. Just introduce myself. I'm Chief Lending Officer at Citizens Bank in Baton Rouge. I've been here for 21 years. I do hold the CCIM designation and was 2016 Louisiana chapter president. As part of the panelists, I'm going to go over the size of everybody's banks. My bank is $367 million in assets and $276 million in loans. We do have 3 panelists joining us today. Mike Carter with Gulf Coast Bank and Trust out of New Orleans. Mike is the market manager and vice president in the commercial lending division. He's been at Gulf Coast for 16 years and is a graduate of the Graduate School of Banking at Louisiana State University. He did have prior experience in the hospitality industry. Gulf Coast has assets of $2.2 billion and $1.6 billion in loans. Also like to recognize Brad Jongbloed. He's the vice president and commercial lender at MC Bank and Trust, which is in the New Orleans and Morgan City markets. He's responsible for commercial lending and in the New Orleans market. He also is a graduate of the Graduate School of Banking at LSU. Started his career as a commercial real estate broker with Latter & Blum and has come to the banking side. The bank has $333 million in assets and $232 million in loans as of June of this year. Damon Migues, First National Bank of Jeanerette. They serve the Acadiana area. Damon is president and CEO. He's been there for 24 years. Began his banking career in commercial lending and also managed loan operations at the same time. He's been president since 2010. The bank has assets of $311 million and $222 million loan portfolio. So thank you everyone for joining us today. We're just gonna have some questions to pose to the panelists, and then we're gonna open the floor for Q&A. Like Amy said, if you have some questions that pop in your mind, you can use the chat feature and we'll jump to those after the first part of the presentation. So Mike, what markets does your bank serve, Gulf Coast?
We're actually all over the map now since started here at the bank. Our core bank was founded in downtown New Orleans with 1 branch, and now we have 19 that span west of Baton Rouge, east of Slidell. We cover all of the St. Tammany Parish and Tangipahoa Parish, and then all the way down to the Gulf. So that's the core footprint of the bank, being a state charter bank. But we do also have offices in Texas. We have an SBA division that we founded about 2 years ago in Texas that does SBA lending nationwide, mortgage offices throughout the Gulf Coast. And we've really been growing our business credit or factoring division, if any of you are familiar with that type of lending. And they've got offices all over the country, in Detroit, Denver, Dallas, Houston, you name it. They're all over. So while we're still I consider us a small community bank in South Louisiana, we do have a footprint throughout the country.
Good deal. And your counterpart, Gary Littlefield in Baton Rouge, is the president of the Louisiana Bankers Association.
Yes, sir, he is.
He represents our industry well.
No, thank you.
So how do you view the current business and real estate climate?
That's a tough one to tackle. I mean, if I could sum it up in one word, it's strange. And I guess, like always in Louisiana, one market isn't indicative of another, and vice versa. It's kind of broken up in sectors. I think all the panelists would agree, and I'd like to hear their opinion on it. I don't think any banker or anybody in real estate as a whole thought that the residential real estate market would hold and do as well as it has. It's actually been quite astonishing, the production that our mortgage division has done. And I think a lot of that has to do, Jim, with the mortgage rates are near or at historic lows that they've ever been. So, of course, that increases buying power of people. And I think some of the motivation or the incentive there too is people sitting at home that, you know, maybe they've been considering upsizing or increasing or adding square footage, you know, for some time, but this was the motivation, being at home so often, to do so. So all over the regions we serve, we've seen that same thing repeated. The business climate obviously has really been affected more, and I kind of look at it in sectors. You know, certain sectors, especially in my territory, have really been hit hard. Anything related to tourism or hospitality or restaurants or short-term rentals. So, you know, we do have some clients that have suffered greatly up until this point with the COVID and the subsequent shutdown. But we've also had some clients do extraordinarily well and use the pandemic as a catalyst to tighten the belt, run more efficient operations. You know, we all get lazy when times are good, but when times get lean, is our opportunity to clean up the books and be more efficient, which I think we probably all saw post-Katrina. You know, the companies that made it through actually were far more profitable when it was all said and done, and could make more with less. So we see that trend happening again here. And, you know, I haven't really seen a catastrophic downturn, at least in the New Orleans market, in my portfolio, for example, which is a real blend of CRE, investment real estate. So, you know, I think in large part too, that's because community banks tend to work with their customers. So we've been doing deferments and helping people with getting their PPP loans and assisting through the SBA IDL process. So I think that's had a lot to do with it. But we'll see when the stimulus money runs out over the next couple of months, you know, what the real effects are, and which businesses are going to struggle and which ones are going to thrive.
Good deal. I'm going to jump over to Damon, who's in the Acadiana area. Damon, business climate over there. Do you want to make a few comments? I know y'all are right next to where the hurricane hit, and we had PPP, we had COVID, and not much more else that could be thrown at us. So, how are things over there in Lafayette?
I tend to agree with Mike in the fact that it's extremely strange. We didn't expect to be at this particular point in time this year. However, the real estate market, especially in the Lafayette area, has continued to strive. You typically don't see that when you run into this type of economy, but with us, we're still seeing records. And for me in particular, we don't do a lot of the 1 to 4 family, personal resident dwelling, the long-term fixed rate mortgages. But the other stuff continues to move. You have and again, I've had customers, depending on what particular industry they're in, but there are a lot of buyers out there who are looking for opportunities.
Good. Brad, over in y'all stretch from New Orleans to Morgan City. We'll stay on this topic for another minute on the current business and real estate climate. What are you saying?
Yeah, I agree with the other panelists. Very, very strange. But I think that PPP, the EIDL loan program, the stimulus in various forms have injected a lot of liquidity into the market. And I think that may be one of the causes that's propping up commercial real estate. You've got the companies that were healthy that received aid and received these source of liquidity. They've got money to go shop with to buy. The COVID has changed the way certain companies view and use real estate. So you've got in the New Orleans market, you've got some people maybe rethinking downtown and maybe looking at suburban office space. Some want to spread out. Some want to be more flexible, offer more work from home like we've been seeing. Time will tell whether or not that trend sticks or whether it goes to a, flexible, come into work a few times a week, work from home a few days a week. So we'll have to see how that shakes out. New Orleans obviously is a very big hospitality market that's been hit extremely hard. I think you see a lot of, on the personal side of travel, people still wanting to take trips when they're staying with their family. There's less risk. They can still go and do things where they can socially distance. But on the business travel side, that has been severely taken back. That's probably not going to return to normal for quite some time. And so you've got a lot of pressure being put on anyone in hospitality in short-term rental. The multifamily market has held up pretty well, but you've got the eviction moratoriums, see how that plays out. We're watching collections of our landlords and new deals that come through to see not just the rent roll, but how are the actual cash collections. Nationwide, you've had a little bit of a disruption in retail from the Amazons of the world and all the shopping from home. New Orleans, we don't have excess land, so it doesn't tend to expand too rapidly, get overbuilt. So, I think that New Orleans is a little bit more insulated from some of those forces in retail. The biggest changes you're seeing is hospitality, and then, we'll have to see what happens with the office market. But by and large, I think the New Orleans market has been very resilient and has held up pretty well from an economic standpoint.
Good deal. I see Jacob Christ is on the call today, but I wanted to ask our bankers in New Orleans, the Port of New Orleans, has there been any changes this year in activity and warehouses and all that? I mean, y'all seen anything there? I guess not.
Actually,
if I could unmute Jacob, I would.
Unfortunately, I don't have a whole lot of experience in the port area, but I've not heard of any real major interruptions. I'm sure there has been with the supply chain issues, which has trickled down. Brad, I'm sure you've seen it. For everybody on the call, be aware, we're seeing material cost on construction projects go through the roof. Mm-hmm. Lumber is up somewhere in the 60 to 70% above just 2 months ago. So certainly there's effects that are going to continue to trickle down that we have to be aware of, but just trying to get our grips on it. We do have some contacts at the St. Bernard port, and from their reporting back to us, things are going really well. That's been largely uninterrupted, but I'm not really sure about Orleans.
I'm going to transition to deals. How long?
Jacob Christ, I can chime in.
Oh, Jacob, yes.
Good afternoon, everybody. So New Orleans we're busy in certain key areas. So on the container side, we've pretty much bounced back to normal. The break bulk side was struggling to begin with. COVID has hurt it a little bit worse. So that's not doing well. The cruise, obviously, we got word from Carnival within the last few days that they won't be sailing until at least April, May of 2021. That's a huge item for us. Hopefully the other large cruise lines won't align with their judgment call. We feel like that's really, really conservative, but yeah, it's been tough. It's been tough. River traffic with export grain has been kind of as normal. Railroad business has been booming because we generate a lot of revenue off of storage, which when there's a lot of rail cars being stored, that's a good sign for us. Revenue is not a good sign for industrial users. So yeah, we're definitely feeling the pain for sure.
Good. I'm going to transition to deals and how long it's taken from the time the bank gets, discusses the deal with the borrower and it gets rolling. Any of you guys want to talk about the length of it. We had received a lot of questions early on about how long it's taken to get deals done these days. Just going to throw that out. From start to being able to get to the closing table. And the banks obviously make that happen.
I'll jump in first. During the PPP rollout, I would have said a whole lot longer than now, but now that that's largely behind us and those loans are starting to move into the forgiveness phase, you know, we've kind of settled back into our normal time frame as far as approval to closing. You know, it's kind of a hard question to answer because it really depends. You know, how complex is the deal? You know, what are all the moving parts? Yeah, I would say for, you know, like a standard investment property purchase that's move-in condition, that's got existing tenants, so, and you got a borrower with pretty simple financials, you know, 30-day turn time from application to closing is not unreasonable. But, you know, you get into renovation loans or construction loans or multi-tenant properties or environmentals if we need that. Of course, that's all going to take longer, and the turn time on third parties, like environmentals and appraisals, has largely been extended a little bit. Not grossly delays, but quite, you know, 20-30% more than probably prior to the pandemic. You know, what I try to coach my clients, and I'm curious to hear what the other panelists say, is get me involved as early on as possible, even if it's prior to executing a contract, because usually we can talk through what will be needed, what the bank will require, so that they can set realistic expectations on a closing time frame. And one thing I'd like to throw in there too for the brokers on the phone call, the CCIMs, is, you know, it's a good idea also to understand the complexity of your owner or the borrower or the buyer in the transaction prior to making an offer too, because I'll give you an example. I had a customer last week that had 35 different LLCs under his ownership. And if y'all are not aware, we have to do a global cash flow per regulatory standards now. So we can't just do a one-off deal based on that property itself. We have to look at the borrower's overall financial picture. So in his case, by the end of it, we had 135 tax returns and well in excess of 35 financial statements. So yeah, that one didn't close in 30 days. But you know, the more we all communicate on the front side of the transaction, being the agents, brokers, borrower, and bank, the more realistic we can come up with a date. And a lot of that has to do with how prepared the borrower is on the front side. If they come in and they don't have their financials current or tax returns filed, you know, those are all things that we can't do anything without. So I'm curious what the other guys are saying.
Brad, you got something?
Yeah, if I could add to Michael's point, yeah, he's absolutely right. I mean, we have to do a global cash flow analysis, and especially with real estate investors, they tend to have many LLCs, unlike a company owner that's buying a property to be owner occupied. Generally, that's their main thing, and we can look at their financial statements and fairly quickly assess what the global cash flow is. You got cases where you got seasoned real estate investors, like what Mike was saying, 35 tax returns. We see that from time to time. It can be a lot to go through, and it oftentimes prompts us asking many questions about various pieces of debt and what the repayment of those terms are of that debt, so that we can put all this together. My advice to your clients that do have situations like that, which there are many of them, one of the best things they can do is have their CPA on a regular basis prepare a statement that itemizes all of their debts of all of their related companies to you know, a brief sentence or paragraph of each. What is it? What is the asset securing it? What are the repayment terms? What are the payment amounts? That's something that we can look at, put in a spreadsheet very quickly, and determine a global cash flow analysis. I'm a former credit person, probably these lenders are as well. That's a beautiful thing when somebody hands you something that basically outlines the entire debt schedules of all the related interests of that borrower, because we can very easily put it together. And what that means is a quicker turnaround time and a quicker answer and a quicker approval. In real estate, deals are time sensitive. So we want to move as quickly as we can on any deal, purchase or refinance. But in the cases of purchases, you oftentimes got an antsy seller, and you need some certainty, and you need some answers so that you know that you can get the loan that you need. At MC Bank, we're pretty quick on turnaround times. Was so pleasantly surprised when I started working at this bank that our credit department turns them around very, very quickly. So we can get an answer back very quickly. But as Mike was saying, that's just the first step is application. The second step is get your approval. But then you've got your third-party reports. You've got your appraisals. I think those have been running a little longer lately, and environmentals. But really getting to that, is it approved or not? That's what you need right away, and everything else can fall into place there. Other piece of advice I'd say is, at the point of application, or when you're talking to your clients, talking to a banker, get as much information out as possible. Have the purchase agreement, have the basics of the deal, have a discussion about what will work, what won't work. Is there anything that the bank needs to know about that that you don't want them to be surprised about later? The more information and the more you can build that relationship early on, the better. So that's some advice I would relay.
Okay, I'm going to shift to another area. Damon, I may let you start with this. Maybe pick a property type or two that is really hot and attractive for the bank to finance, and maybe one or two that you're shying away from, just to let everybody know on this call. The regulators have different property types that they scrutinize more or less, and our boards of directors have different goals on the portfolio mix that we have. And if you come to me for industrial loan, my industrial bucket may be a little full, and we may not have as aggressive terms as maybe one of the other people on this panel, and vice versa. So Damon, I'm going to throw that to you. Property types, good and bad, and don't touch it all.
For the most part, the commercial real estate for us in our area is what's really the hottest part. Our bank examiners are fine up until a certain point, and I say that because there are some concentration limits. So for us in the small banking world, it kind of depends on where your makeup of your entire bank portfolio is. As you get closer to concentration limits, they start to tighten down a little bit. They want more information, they want more detail, or they actually want you to stop. It's extremely tough for us to want to say we get to a point with a customer, or even if it's a new customer, existing customer, regardless of which one it is, to have a really good deal come across and a bank examiner tell you you have to stop because your concentration levels are getting high. They're starting to back off of that somewhat and giving us more flexibility. When you do that, though, it's going to require us as bankers to ask more of the customer. They're going to want to underwrite it a little bit stricter. They're going to want to loosen up the terms a little bit as far as what the customer's willing to get into it. So the more solid deals are going to get through a lot faster, a lot easier. For us, it's in our area. I think the thing that moves the best, or that we're having the most success with, is non-owner occupied commercial. That seems, for me in my market and my bank, to be moving the best for us. Turnaround times are really easy on it for us. The biggest problem that we're having is the secondary parts. In Lafayette area, we're finding the title companies, the attorneys, and the real estate agents are just the appraisers are probably about 4, 5 to 6 days behind schedule on some things.
Good.
As far as staying away from something, as much as I hate to say it in my area, anything oil and gas has a big red flag on it for us right now, whether it's regulatory or not, unfortunately.
How about in the New Orleans area, Brad or Mike?
Yeah, we're kind of heavily scrutinized oil and gas and staying away from it as much as we can, even though we are, based in Morgan City. I don't see a lot of that in New Orleans. I've traditionally been more of a real estate lender. We're very cautious with hospitality, very cautious with short-term rental, but we're really not staying away from anything. We don't have any current concentration issues. So we're pretty open on anything we look at. We offer slightly better terms for owner-occupied commercial real estate than we do for non-owner-occupied, but we try to be as competitive as possible with all property types.
And I chime in on that if I could. You know, to Brad's point, I think one of the differentiators between community banks and the larger regional and national banks is, you know, they tend to turn the spigot on and off based on national economic data, where I think it sounds like all of us make decisions on a one-on-one basis with a borrower. So, I mean, quite frankly, I just did a restaurant deal last week, which sounds crazy during this period of time, but the borrower has actually found a way to grow his business as a result of COVID instead of it hurting him. He was pretty aggressive in getting out ahead of it and expanding his takeout capacity. So, you know, I like these guys. We don't really have any concentration issues per se, but I think every bank has a affinity for what they like. We tend to like investment real estate, owner occupied and non-owner occupied commercial. If we've kind of shot away from anything for my career here, we tend to not do a lot of hotel deals unless, you know, we use the SBA or some other government type program for them, just because of the volatility in that industry. And we don't really do a whole lot of industrial because there's just not a whole lot in our market. But everything else, we've got no marching orders from upper management that you can't do this or you can't do that. It's, you know, obviously pay closer attention and be a little more cautious with the industries grossly affected, but let's look at each deal on a one-off basis.
Good deal. Well, I'm going to switch over to Q&A, and we have our first questions from Matt Eaton, who's at the Bulldog right now. He talked me into doing this deal, and I'm drinking a tea. He's drinking a beer, but anyway. Matt asked, have you guys seen a large influx of new customers coming to your bank for loans since many of the largers have decided to slow or stop lending? And I'm going to add a little caveat to that. I can speak for all the people on bankers on this call. The PPP rollout in April was a huge undertaking for us all, but it was but we definitely led every aspect of this program. Community bankers got a ton of, we put in 60, 70 hours a week. And I know for my part, we grew 12% in 8 weeks, $35 million. So as a result, I think we're already seeing they had fallout from the regional and national banks. It was documented, it's all over the news. I normally don't like to talk about competitors, but we rocked in this area and showed what a community bank was about. So I think I know I'm starting to see deals come to us, even though a lot of the PPP was for operating businesses. Now they're starting to do deals, they'll come to community banks. So I want to open up this question to everybody else, you know, about, again, I'll read it again. Have you had new customers coming to your bank since many of the larger have decided to slow and or stop lending?
I'll jump in. I'm sorry, go ahead, Damon.
Absolutely, without a doubt. That trend kind of started somewhat a little bit before PPP, but since PPP, it's probably doubled in the amount of customers that we're seeing that migration over. It's from a small community bank where you may never be the lowest cost provider, but I think through all of this, the customer has started to understand that they put a small price on premium of customer service. And that's what they're going to get at the community banks. And the fact that through PPP they were able to help some, it's been a tremendous help for us.
Good.
Yeah, I'd agree. I mean, I'm sure none of us were real happy about doing 60, 70-hour weeks back, but you know, the resounding theme at the bank was we need to do this. The customers need us right now. And you know, from some of the largest banks, at least in our market, not participating at all, you know, we had to kind of step up to the plate and help out our community. And I'm sure it's just like the same for you guys. Community banking is in our DNA. If we're only as strong as a bank as our customers in that market, and you know, our kids play ball with your kids, and we coach the same sports and run in the same circles, so we have the same interest that the consumers do as well as our business owners. And Jim, to capitalize on your comments, I was actually reading a report the other day that the SBA put out, and just the first round of PPP funding was a little over, was it $525 billion issued, and about 5.2 million, 5.2 million applications. And of that, banks with under 10 billion in assets, which by their definition is considered small banks, handled well over 52% of all the transactions and roughly 45% of all the funds issued. And just to put that in perspective for the people on the phone call, if you didn't know, the top 5 largest banks in the country hold well over 55% of all the cash and assets of the American public on deposit in just 5 companies. So for us small little guys, being able to get out there and do well over 55%, 52% of all the PPP funds, I think we all should pat each other on the back. It was a big undertaking, but it was sorely needed by our communities. And we've grown from it. Like you guys, we were at about $1.8 billion or $1.9 billion or so a year end, and now we're up in the 2.2, 2.3 range. So we've grown pretty substantially in the first part of this year because of it.
Good. We got David Gleason in Lafayette. We're seeing interest rates at an all-time low right now. What's your prediction on rates in the near future? If you had a crystal ball, will they stay low for the next 6 to 12 months? Does anybody want to take that fun question?
I'll jump in. You just had the FOMC meeting, Chairman Powell indicating that they intend to hold rates near zero. I believe it was till 2023. So, you know, one thing we talk about interest rates as interest rates being low, and they are, but there's different types of interest rates. So when the Federal Reserve says keeping them near zero, you know, that's the Fed funds rate. That's, you know, not to get too technical, the overnight rate that banks lend money to other banks to you know, shore up their balance sheets and make sure that they have adequate liquidity day in from day to day. But then you have the prime rate, which is based on that. So it's 3% over that. The Fed funds rate is technically 0 to 1/4%. Prime just grabs the quarter and adds 3 to it. So you got a prime rate of 3.25%. That's generally what the best clients receive on a floating basis for a working capital line of credit. So, you know, having a floating rate loan is, you know, not so scary when you've got the Federal Reserve Chair saying that they're not going to touch that for, you know, 3 years. So you look at the Treasury yields is the best indication of what similar duration money gets priced at. So if you're looking at a, let's say a 20-year amortization, but it's got a 5-year balloon or a 5-year adjustment period, which is typical on a commercial real estate deal, you could look at the 5-year Treasury yield index, and depending on whether that's moving up or down, that may put upward or downward pressure on a bank to look at what they're charging for 5-year money. The mortgage rates are typically a 30-year mortgage typically follows a 10-year Treasury, and the reason 10, that for a long time was the average duration of a 30-year loan. It would get, either the house would be sold or be refinanced. It's probably quicker than that these days, the way everybody refinances now. But those are the capital markets that you would look at to determine whether or not, you know, the actual Main Street loan rates that go to your average customer walking into the bank, which direction may be going. If the economy strengthens next year, you'll see upward pressure on Treasury yields, which would put upward pressure on bank loan rates, and same with the mortgage market. So that's typical of the correlation of the direction of rates. If we feel like rates are going to be rising, it's probably an indication that we feel like the economy is strengthening. So it's not all bad, because it could mean more money in the pockets of, say, a landlord or a business owner. So even though the borrowing costs may be going up, their cash flows may be going up too. But, you know, long story short, we're going to be in a low rate environment for a long time.
Okay, Mike Nito said, I've heard some big players are looking to buy companies to get the distressed real estate assets, possibly delaying the time it takes for those properties to come to market. Have you heard or seen some of this activity? I do want to say sheriff sales are taking forever. I had something that was set for in March and it didn't go until next month. So there's opportunities to buy the distressed assets before they leave the bank's books. I can tell you that. So, but does anybody else want to answer that?
I didn't actually hear the question. Do you mind repeating it for me, Jim?
Oh, we've heard, one of the attendees said they've heard some big players are looking to buy companies to get into the distressed real estate assets, possibly delaying the time it takes for those properties to come to market. Have you heard or seen some of this activity? I'm not aware. I don't know.
I'm not aware.
No, myself either. I think it's kind of too early. You know, they might have some companies that are positioning themselves, but with deferments from banks on existing debt, you know, the PPP money, EIDL money, I don't think we've seen the beginning of what would be distressed. At least I haven't. I can't speak to y'all's portfolios, but our delinquencies don't look any different right now than they did at the end of last year, ironically, which is good news for the markets. But now that the stimulus is close to done, it'll be interesting to see what happens going forward.
Okay, I have a question for Martin Miller, Remax Commercial, New Orleans. What rates and terms are being offered on local commercial investment properties fully occupied under 5 million? I think everybody on this call works in that space. That's a loaded question, Martin. I'd ask any of our panelists to jump in. There's a lot that goes into it.
Yeah, I get this question all the time. You know, the way we do it, and I'm sure the other guys do it as well, is we do risk and relationship-based pricing. So it's not just a rate sheet price like in the olden days that everybody that walks in the door gets the same pricing. If somebody's a deposit customer, if somebody has treasury products with us, if they have wealth management products with us, they're obviously going to get more preferential pricing than somebody that has no relationship with us. You know, I will point out with the rate environment, one thing that came up a lot, and circling back to that, is the expectations on banks as rates are going to drop immediately when the Fed drops funding rates. And frankly, it doesn't work that way. And you know, if y'all can help educate your customers for us, that'd be great, because banks have deposit commitments that extend past a year, 2, 3, 5 years. So just because the Fed fund rate is at a quarter, or, you know, or 1% or below, doesn't necessarily mean the pricing of loans moves lockstep down with it. It takes time for commercial pricing to balance out with the deposits, or as Brad mentioned, the duration of the balance of loan to deposit. So, you know, it'd be hard for me to guess without knowing more about the person's credit score and their risk rating and relationship. But I would say somewhere in the 4s or 5s, based on all those variables, is kind of where we would be right now on a good looking file.
Yeah,
Better for a bigger relationship.
Historically, I think banks, they try to watch their net interest margin. And,
Yeah.
you know, even if our average deposit customer is receiving 0% interest from us for their savings, you know, banks have typically wanted to have at least a 4% net interest margin. So that means that with a zero cost of funds, which no bank has a zero cost of funds, but they are very, very low historically. Most banks there's a lot of banks that are probably a little bit under 50 basis points in their cost of funds. Some maybe even much lower. So if you look at a 4% on a 50 basis point cost of funds, you're at a 4.5% interest rate for a really good customer. You know, we've got to not only cover our cost of funds, but our overhead, our reserves for losses. There's many things that go into that. So you know, with the cost of funds as low as they are right now, you're almost very close to the bottom of where banks would be rate-wise. You know, they're not, you know, these fantasies of negative rates and stuff in other countries. I don't see it. So I don't think it's going to get much better than it is right now for those looking to borrow money for whatever you're looking to borrow for and whatever your risk profile is. Because like Michael said, you're going to get priced accordingly to, number one, your risk profile that we will determine. And it's, it's human beings. It's not a form. It's not a set formula that we learn in school and apply. I mean, we use our best judgment and our experience. And then to his point as well on the relationship, are you an existing customer? Do you have lots of deposits with us? Are you using other products? We'll even take into account, your center of influence or your referral source. Do we feel like you're going to bring other business to the bank? The more you can do as a borrower to be of value to the bank, the more we're going to try to roll out the red carpet and get you exactly what you're looking for and the best deal. None of the community bankers on this panel or in the market want to be the low-cost leader. We're not looking to a race to the bottom. So that's why it's so important for a borrower to position themselves to be a partner with their banker to bring as much of their business as they can. Don't ask for a loan from Gulf Coast, but have your money parked at MC Bank. Try to, have a meaningful, full relationship with one or two banks that you can rely on, and that's going to create the most meaningful working partnership and get the best results for everyone involved.
We have a question from Barry Spicer. Barry's the 2003 International CCIM president. Thank you for your question. Barry, what are you seeing on appraisal values, and how are the appraisers adjusting for the effects of COVID? If the appraisals are coming in lower, are you increasing loan to value ratios to get borrowers to the levels that they need? Anybody want to take a stab at that?
Yeah, I could jump out. I've seen across the board appraisals in the last few months have been fairly conservative, in my opinion, probably 10 to 15% low. And to answer the second part of that question, unfortunately, no. I mean, these are the times where regulatory pressure is pretty heavy on banks and how they react to times like this. So if anything, I think across the board, lenders have become more conservative as far as loan to value positions and equity positions on behalf of the borrower than before, just because we know what's coming when the examiners come into the office. They're not going to like to see us doing a bunch of 85, 90% loans. And that's proof positive. I'm not sure if you all are aware, if you keep up with it, but a lot of the national companies have completely eliminated home equity lines of credit, high loan to value products. They just don't even offer them anymore. And that's a direct result of the uncertainty of COVID and, what will that have? What effect will that have on the underlying real estate value? So, I mean, historically, in every tragedy I've been through, I don't know what you guys have experienced, but we always see a quick reaction on behalf of the appraisers in adjusting their appraised values down, a little bit of CYA, but it's to be expected anytime because, there's no formula to price in COVID into an appraisal. So it's really their opinion of the current market, especially on commercial. Residential, I think, has stayed pretty status quo because there's a lot of activity to justify it.
Anybody else have comments on appraisals? We still have room for a few more questions if anybody wants to send to the chat box. Banker tip from Louisiana CCIM in the chat box says, be a partner with your banker, create the most meaningful partnership, and create the best results for everyone. And Matt Eaton just texted me and said I had to say, and you can take that to the bank.
That's great.
I want to echo something Michael said. When we're pricing, we may not always be the best price in town. It's because think about back in March when you called your bankers for deferrals. I believe I can speak for everybody on this call. We granted deferrals on any loans that were needed, and are there to work with people during this crisis. So those are the kind of things that aren't factored into decisions a lot, but that is another community bank caveat. Okay, somebody is using a computer with the name Michael Carter because it says, how does Michael Carter have so much bounce in his hair? Is it part place? All right.
That wasn't me.
Okay, Matt Eaton, at what point do you, I gotta read his before I say it out loud. Okay, what's your sweet spot on loan size, and at what point do you guys pull in another banking partner on a deal? That's a good question about participations. Anybody want to take a crack at that?
I'll jump in. I know every bank is going to be a little bit different, and a lot of that's going to depend on the size of the bank's balance sheet and their appetite for risk. MC Bank, we typically, our sweet spot is anything up to $5 million per relationship. We can go higher than that, and that's a great question because most banks do utilize participations. And I think most are familiar with that, but basically it's when one or more banks partner up to kind of slice up the deal. The one bank is in a lead position. So generally the bank you're talking to is going to be the lead bank. And it's something that's seamless and happens behind the scenes between the banks. And it's really not anything that the client itself would have to deal with. They get one loan statement, they make one payment, the banks divvy it up on a pro rata basis. So for MC Bank, we can go 10 million plus when we're bringing in a participant bank. But our sweet spot of holding the deal itself is anywhere from 0 to 5 million.
I'll add a little to it too. Typically, we've seen mostly in the southern part of the state, the threshold for everybody is about 75% of their legal lending limit. The one thing that has changed significantly over the last 5 years is the smaller banks have understood that the participation part of it has become bigger and easier for us, because if we don't do it and communicate with each other and help each other out, we're not going to last against a bigger bank. So it enables us to get together, whereas before, from a participation standpoint, the biggest part of the problem was if you had a credit in South Louisiana and you snatched a partner maybe in the northern part of the state or Mississippi or somewhere else, they had trouble understanding what that credit was based on the regional part of it. Now, community banks are doing a much better job of working together within a closer proximity to each other, and it makes it a whole lot easier for us to put bigger deals together.
Yeah, and I basically mimic the same thing Brad said. Our legal lending limit is pretty high, but as a risk mitigating strategy, we've always kept our relationship exposure pretty low, relatively speaking. But our sweet spot's somewhere in the $5 million range, but we participate often to get above that, sometimes with a syndicate of other lenders if we need to stack up a few of them to get where the client needs to. But I would say our target range is in the $5 to $7 million range and below, which is the large majority of the needs of the small and medium-sized businesses in our area. None of us will be banking the Marriott.
I think we've got all the questions answered. Just want to thank Mike, Brad, and Damon for y'all's time today, and thank you, Amy at Louisiana Realtors, for putting this together. And we will, I think they'll be rolling out more of these as time goes on. Matt, or Flo, do y'all have anything to add before we wrap up?
No, just thanks everybody for participating. And yeah, we're going to do one more before the end of the year that is going to be discussing appraisals. We're going to have appraisers from across the state to discuss, what they've seen throughout this crazy year. So yeah, stay tuned. That should be coming soon.
All right, and if you haven't taken advantage of 101 or intro, try to do that. And we have the golf tournament coming up as well. Thank you, everybody, for participating.
And you can take that to the bank.
You can take that to the golf course or to the Bulldog.
Jim, thank you for your participation today.
Yes, thanks, Jim.
And thank you also to all the bankers for all that you do for our communities. We really want to thank you for all the heavy lifting and the engagement. Truly appreciate it and feel so assured bringing our clients to you. So thank you so much for your time today.
Thank you. And
Thank
thank
you all.
everybody for organizing
Thanks.
this. We appreciate it.
Bye.
Go register your team for the golf tournaments. Get signed up, Jim.
Have a great day, everyone.
Thanks, Amy.
Thank you.